Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
The true meaning of investment risk and why it matters to you. I regularly discuss investment risk with people. It is, after all, a regulatory requirement to assess and regularly review clients' attitudes to investment risk, as well as their capacity for loss. What I've discovered is that most clients' initial perception of investment risk is very different to the true investment risk. Unfortunately, few could blame clients for thinking that investment risk is the risk of absolute loss of their capital. However, in reality, the risk for most people is, in fact, the shorter-term fluctuation in the value of their investments. In other words, the volatility, rather than the risk of permanent loss of capital as such. The problem is that the FCA measures risk primarily by the volatility of investment valuations rather than by the risk of absolute loss of capital. The FCA does recognise and warn investors against permanent loss of capital too, but when it does so, it goes too far by banning investment in high-risk assets such as cryptocurrency when marketed by UK providers to UK investors altogether, other than for professional investors. By all means, warn investors of the investment risk, but then allow investors to decide whether to invest or not. They are adults after all. Whatever happened to caveat emptor? The issue with measuring investment risk by volatility is that it is a very poor measure of risk, in my opinion. Volatility is not risk. Volatility is volatility, period. The risk of permanent loss of capital, on the other hand, is true investment risk. Absolutely. Let me illustrate what I mean by way of explanation of an imaginary graph. If you can just imagine in front of you, you've got 10 lines over a 10-year period. They're all different colours and they fluctuate up and down at different rates. And below it, there is a list of risk grades 1 to 10 with the results over that 10-year period. What the graph shows is that the investment return of the Parmenion Strategic Passive portfolio we're using in this example, which consists of 12 to 15 funds, over the last 10 years to 1st of July 2021. The portfolio consists of the four main asset classes of cash, property, by which we mean commercial property, equities, in other words shares, and bonds, which means corporate and government bonds, for investment risk grades 1 to 10, 1 being the lowest and 10 being the highest. At the lowest investment risk levels, there is a relatively high amount invested in bonds and property, with a very small amount invested in equities. As the investment risk grades increase, proportionately more is invested in equities and less in bonds and property. What the graph shows is that over a period of 10 years, every single increase in investment risk grade results in a higher investment return. So, investment risk grade 1 produces quite a low return of 15% over 10 years. Investment risk grade 5, for example, gives 87.52%, and at risk grade 10, 129.28%. This backs up every study I have ever read on the subject of investment. Over the longer term, periods of 10 years or more, shares have always outperformed all other asset classes, including property, on at least 90% of occasions. And that's according to the Barclays Equity Gilt study that goes back well over 100 years and is published annually. Do shares fluctuate in value? Absolutely. Is there a risk that some companies within a portfolio of funds could fail? Yes. However, within a typical portfolio of, say, 750 shares, which is made up of 15 funds that invest in 50 shares each, like the Parmenion strategic passive portfolio that we are referring to in this example, how many of those 750 companies will fail in a year? Well, even during the last 16 months of the coronavirus pandemic, very few, if any, companies in this portfolio have failed. So how risky is that? Not much, unless you are reliant on a high income from your investments. So I put it to you that an investment in a large and diversified portfolio of assets over a period of 10 years or more is not high risk, but you will experience volatility in prices, fluctuations in values. If, on the other hand, you were to invest a large proportion of your investable assets into a single company for a short period of time, then you would be taking very high risk indeed, because you would be putting all of your eggs in one basket. What's more, if the company were to fail, you would lose your entire investment because there is no investor compensation for single share investments. That is risk, permanent loss of capital. Furthermore, the investor compensation scheme is not available to protect your investment in a single company share, whereas a fund has investor protection of £85,000 per fund management group per person. Using the Parmenion strategic passive portfolio as an example, an individual investor has £1,275,000 investor protection in a portfolio of 15 funds with 15 different fund management groups. A joint investment by a couple doubles the investor protection available to £2,550,000. This is because, of course, you get £85,000 compensation per fund. Pretty good, eh? What's more, all collective investment schemes, by which I mean unit trusts and OICs, have independent custodians, which are usually large banks. This means that your fund investments are registered in the names of these custodians. If the funds were to fail, then the fund management groups could not touch the money as it is ring-fenced. A fantastic safeguard for investors, don't you think? Those of you who remember the Barings Bank failure as depicted in the film Rogue Trader will recall that the trader Nick Leeson brought down Barings Bank through negligent trading. The bank had a fund management arm called Barings Fund Managers. Depositors in Barings bank accounts lost 100% of their deposits above £20,000, which was the then investor compensation limit of £20,000. Whereas investors in Barings funds lost nothing. The reason for this was because all of Barings funds had independent custodians, so investors' money was protected. So the message is that long-term, 10 years or more, in a portfolio of collective investment schemes, OICs and unit trusts offer investors very high levels of investor protection. They also offer the highest investment returns if your money is mainly invested in shares. There is an argument that long-term investment in collective investment schemes primarily invested in shares are lower risk investments than bank accounts. In the 60-year history of the Investment Association, which governs unit trusts and OICs, in other words collective investment schemes, no investor has experienced a loss of money due to the collapse of a fund. During that period of time, a number of banks have failed, such as Barings Bank, and lost depositors' money. A permanent loss of capital. That is high risk. Absolute risk of loss of capital. I believe it is high time for the FCA to redefine investment risk as volatility, not risk. True investment risk is the risk of permanent loss of capital. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.